Most people give up right before their compounding starts to work. It's that frustrating period when you're saving, investing, and doing everything right. Yet your results feel stuck. You keep adding to your portfolio, but it hardly moves. That stage is not a failure. It's part of the natural process that happens before your compounding takes off. Everyone who has ever built real wealth has gone through that same quiet phase. The truth is, compounding never looks powerful in the beginning. It's slow, uneventful, and even boring. For months or years, you'll feel like your effort is far greater than your reward. You'll wonder whether your money is really growing or just sitting there. But that slow period is not a mistake. It's a buildup. It's the quiet stretch that every investor passes through before the acceleration begins. Here's why this happens. When you first start investing, most of your growth comes from your own contributions. If you invest $500 every month, most of the progress you see at first comes from those deposits, not from returns. You might earn a few dollars in dividends or interest, but it barely changes your balance. It feels like your effort is doing all the work. But those small gains are quietly laying the groundwork for what comes later. Over time, each dollar you add becomes another worker in your portfolio. The returns on those dollars begin to compound. Slowly at first, then faster. It takes years for the compounding to overtake your contributions. But once it does, your money begins to grow faster than you can save. That's when the curve finally bends upward. The most common mistake people make is giving up during the early years, right before this turning point. They think their strategy isn't working, or that the market is too slow, or that they need a higher return. But most of the time, nothing is wrong. They're simply in the early compounding phase. And the only thing separating those who build wealth from those who don't is endurance through this quiet stage. Let's put this in perspective. Imagine you invest $10,000 at an average return of 8% per year. After 1 year, you've earned just $800. It doesn't feel like much, but keep it invested. After 10 years, that same $10,000 grows to about $21,500. That's still not life-changing. But after 20 years, it's $46,600. After 30, it's $106,600. You didn't add a single dollar, time did all the work. And that's just the math on one small seed. Add consistent monthly investments and the growth curve becomes exponential. This is why the rich rarely chase quick returns. They understand that compounding isn't about speed. It's about staying power. It's not how fast your money grows, it's how long you let it grow without interruption. That's why consistency beats intensity. The investor who quietly contributes for 20 years often ends up far ahead of the one who invests aggressively for 5 and quits. Right before compounding starts to accelerate, most people experience 3 things: doubt, boredom, and distraction. Doubt makes you question whether you're doing the right thing. Boredom makes you want to change your approach. Distraction makes you chase what looks exciting. Those are the danger zones. The people who get through them without stopping are usually the ones whose compounding eventually explodes. According to updated research from JP Morgan Asset Management, the average investor who stays invested for 20 years earns nearly double the returns of those who try to time the market. Missing just the best 10 growth days in that entire period can cut your gains dramatically. The reason is simple. Those explosive days usually happen right after the market feels the most uncertain. The same principle applies to compounding. The moment things feel slow or uncertain is usually right before growth begins to accelerate. You can think of it this way. In the early years, compounding is mostly invisible. The growth is happening, but it's happening in small, quiet increments. Then, as the base of your capital grows, the same percentage return creates much larger results. Earning 8% on $5,000 doesn't move the needle. But earning 8% on $500,000 changes everything. What most people call an explosion is really the natural result of time catching up to discipline. There's a pattern you'll notice among those who build serious wealth. They have long attention spans. They don't panic during slow periods or shift strategies every few months. They treat their investments like a tree, something that grows best when left alone. And the reason they seem to accelerate later in life isn't luck or secret strategies. It's that their compounding has reached maturity. Something else happens during that quiet pre-explosion phase. Your financial habits solidify. You learn to save without thinking, spend intentionally, and manage money calmly. These habits amplify compounding because they protect your progress. Without them, even high returns can't save you. Compounding works best when paired with good behavior. Let's look at what's going on beneath the surface when compounding is about to take off. Imagine you've been investing $500 a month for 10 years. You've contributed $60,000 in total, and your portfolio has grown to around $90,000 with returns. For most people, that doesn't feel impressive. But here's the turning point. From that year onward, your portfolio might start earning $7,000, $8,000 a year in returns alone. That means your money is now adding as much to your wealth each year as you are. The next few years, those returns get reinvested, and the base grows faster. By year 15, the growth could be $14,000 annually. By year 20, it could be $25,000. The same behavior, but now your money compounds at a level that changes everything. The growth feels sudden, but it's just the math finally becoming visible. The same principle applies to any consistent wealth-building system, whether it's business income, real estate, or skill-based work. The early stages are all set up. You build the systems, make small improvements, reinvest your profits, and see little movement for years. Then one day, your revenue or cash flow starts rising faster than your effort. That's when the compounding becomes obvious. Here's the key. The explosion is not random. It's always the result of compounding that was left uninterrupted long enough to gain momentum. You can't see it happening, but every reinvested return, every dividend, every small habit contributes to it. That's why the final stage always feels sudden, even though it's been building quietly all along. According to Fidelity's long-term data, investors who consistently stayed in the market through both good and bad years earned almost twice as much as those who jumped in and out. The data shows that the biggest jumps in portfolio value usually happen after long stretches of flat or modest growth. That means if your investments feel slow right now, you might be closer to your turning point than you realize. The challenge is psychological. Humans are wired for short-term results. When progress stalls, our instinct is to change direction. But in compounding, that instinct often works against us. The wealthy succeed not because they're smarter, but because they've trained themselves to stay patient when results aren't visible. They know that consistency compounds too, not just money, but behavior. So what exactly should you expect before your compounding explodes? You'll likely feel like nothing is happening. Your growth will seem small, your motivation will drop, and your focus will be tested. That's the phase every investor, saver, and business builder experiences before exponential growth. It's not failure, it's the price of admission. The people who reach financial freedom aren't the ones who start big. They're the ones who don't stop. They automate their savings, reinvest their earnings, and keep their expenses stable while their assets grow. They understand that compounding is less about chasing returns and more about protecting consistency. The longer you can stay steady, the sharper your curve gets. And here's the beautiful part. Once your compounding finally starts to accelerate, it rarely slows down. When your portfolio reaches the point where growth happens faster than your contributions, time becomes your biggest ally. Your investments begin to grow whether you add more or not. That's when wealth starts to feel effortless. But remember, every person who reaches that stage went through years where it felt pointless. They kept going when it seemed like nothing was working. They stayed invested when it was uncomfortable. They built habits before they saw results. That's why when their compounding finally exploded, it looked sudden from the outside. But it was just quiet patience rewarded. So if you're in that phase right now, the slow stretch where your portfolio moves inches instead of leaps, understand this. It's normal. It's the stage that comes right before your growth accelerates. Don't change your plan. Don't try to time the market. Keep investing, keep saving, keep building habits that protect your capital. The curve will turn when you least expect it. That's the moment that always comes right before your compounding explodes. The silence, the boredom, the doubt. Stay steady through it. Because once the numbers begin to move faster than your effort, you'll realize that everything you did during those quiet years was exactly what made it possible.